Hi there and welcome back. So we are currently on step 3 of the 10 simple steps in getting pre-approved for a home loan before you start looking at homes. In step 3, we're going to be reviewing your credit as well as understanding your debt to income and how you can calculate your own debt to income to determine what your debt to income is. So first, let's start with credit. And my question to you would be, what do you think the chances are likely that your credit could be incorrect, that there could be something incorrectly being reported to your credit bureau? Well, let me answer that for you. Consumer Report states that 1 out of 5 consumers has incorrect information being reported onto their credit bureau. So that's a pretty high chance that there could be incorrect information. This is why it is an important step that when you are shopping for your trusted lender and they take your application and pull your credit, make sure that lender is reviewing your credit with you line by line. We want to make sure that the information on there is correct. Now, we understand as lenders that your credit report is a snapshot in time. Your credit report is only updated about every 30 days, somewhere between 30 to 45 days. So therefore, you may have a credit card that you've made a payment on, so the balance is a little off, or it could be that you've used that credit card since your last payment and it was last reported to your credit bureau. So there's some information that we have to understand is just a snapshot in time, but as far as incorrect information, we want to make sure we're reviewing that credit with you line by line to make sure we take care of any inconsistencies or inaccuracies. Another piece of information that's important for you to know about the credit bureaus. The credit bureaus themselves are only information gathering companies. So they actually take the information that's being turned into them from creditors and placing that on each consumer's credit report. But it's not their responsibility to verify whether that creditor is sending correct or incorrect information into them. So it is not the credit bureau themselves that's actually placing the incorrect information. So if we find something, if your lender and yourself find something that is being reported incorrectly, it can be disputed or corrected through the credit bureau, but it is going to have to go through a process where the credit bureau reaches out to the creditor and has the creditor agree it's incorrect and then fixes it on the credit bureau. A good lender will provide you with your credit and will check it for accuracy and flaws. So make sure that that lender is walking through those steps with you and not just telling you here's what your credit score is and here's what loan options you have available. We want to make sure, is there any missing information? Is there anything being reported wrong or incorrectly? Are you an authorized user on a credit card that you totally forgot about? Maybe when you were younger you had a parent that made you an authorized user before you were able to establish your own credit, and maybe you're still an authorized user on that account and didn't even realize it. So these are things that are important, and that piece of credit, if you're an authorized user, could be helping your credit or it could be hurting your credit. So when it comes to the debts, let's talk about debts. When it comes to the debts are typically going to come straight from the credit bureau onto the application. But make sure you're thinking about debts that are not on your credit report. Make sure you inform your lender about any 401k loans that you may have. That's not going to show on your credit bureau. If you are self-employed, make sure that you explain to your mortgage lender about any commercial loans that you may have that may not be being reported onto your credit bureau. Easy for me to say. Student loans. Do you have student loans that are in deferment? And if they're in deferment, then that could make a difference on the debt to income, because on student loans, most all lenders have to require that we count at least a minimum payment against student loans, even if they're in deferment, because typically student loans can only be in deferment for 12 months at a time. The only way a lender can completely not count a payment is if we can show that it is not going to continue, or it's going to be deferred for at least 36 months, for 3 years. So on those student loans, just know that even though it shows a zero balance, there is going to be a small payment that's going to have to go into account when calculating that debt to income. Also, co-signed loans. Do you have any loans that you have co-signed with someone on that they're making the payments, and have they been making those payments for 12 full months? It could be that those payments will not have to be counted against your debt to income if we can prove that the other borrower that you co-signed with is making those payments. Just keep in mind that the only way to do this is to prove it with a paper trail. We would have to be able to prove with a paper trail that the other borrower that you co-signed with is making the payments as well as they have been making them for the last 12 months. If that's the case, then there's several loan programs that will allow a lender not to include that payment into their debt to income when qualifying for a home loan. Now, let's review incomes. When it comes to incomes, typically your mortgage lender is going to be going off of base income, which is going to be considered any kind of W-2 income, which could be an hourly rate of pay, or it could be annual salaries. So those are your typical basic incomes, is going to be your W-2 income, based income. Other incomes that we have to prove are going to likely continue for 3 years before we can include that income in qualifying for a home loan is going to be those types of child support, annuities, retirement, pensions, any types of other types of income, and show that they are going to continue for at least 3 years, then they would be able to also be included. And this would also include disability or trust income. So there's different types, just to give you some examples of other incomes that we have to be able to prove is going to continue for at least 3 years. Now, let's talk about a different type of other income, and that is where we have to have a 2-year history. There are some incomes that we have to average. We have to go back and average the last 24 months or the last 2 years history in order to determine what type of income the federal regulations will allow us to use when qualifying a borrower for a home loan. Those types of incomes are going to be overtime, bonus income, self-employment income, 1099 income, or rental incomes, just to name a few. So that gives you some examples of other types of income that you've got to have been receiving for at least 2 years before the mortgage lender is going to be able to use that income in qualifying for a home loan to be able to average the last 24 months. So hopefully that's been helpful on giving you that information as well on the debt to income. Now, your income and your debts plus the new house payment, the new principal and interest, plus the property taxes and the homeowner's insurance are going to equate into what your total debt to income is. So if you want more information on how to calculate the debt to income, make sure that you go to the terminology section where I explain exactly what a debt to income is and how to calculate that. Now we're going to be moving on to step 4 of 10, and that's going to be maximizing your credit score to ensure that you receive the best rates and pricing available to you. See you at step 4.